Hello, everyone. This is Sunil here again, and welcome to my channel, Forex with SK. Now, today we're going to move on to the next step and learn about risk management. In our previous sessions, we've already learned how to create charts, create some very simple moving averages or Ichimoku charts, whatever our strategy. But today is the most critical piece where we take each of those strategies and learn to apply good risk management principles. This series is strictly for educational purposes and must not be construed as investment or financial advice. Trading foreign exchange involves financial risk and could result in significant loss of capital. So you must consult your financial advisor before risking your personal finances in trading foreign exchange. Trading involves uncertainty. Past performance is no guarantee of future gains, and the views expressed herein are entirely my personal views and do not consider your personal financial situation. Also, please check the regulatory restrictions that might apply to you in your country before you undertake foreign exchange trading, because the laws in each country are different. Now, there's a number of steps, important steps in the risk management process. So the first step is identify a stable medium or a long-term trend that you're trading with. You could apply the same technique to scalping as well. But here we're going to consider a medium-term trend in today's example of, let's say, a weekly uptrend. And we'll trade with that trend line. So broadly, as a strategy, if you're long, which is what our example would be, then we would be looking for dips to take additional trades. And if you're short, you're looking for rallies. So in our case, in the case of a long trend, we're going to take a long on every dip and we'll place a stop loss at the trend line. We'll size our position for a maximum 2% risk and set targets at either 1-to-1 risk-reward ratio or 2-to-1 risk-reward ratio. Thereafter, we will monitor the portfolio, move the closed trades into history, and monitor our trading stats to validate the strategy. So we'll go through the last few steps in more detail, and we'll use a spreadsheet to do it. And then I'll show you how we document our trading diary to actually get these stats. Now, in this example, let's assume we're in a weekly uptrend with a 3-day swing low of 6415. So in this example, this is a swing low of 3 days. And let's assume this 3-day trend is valid. And so the moment this trend is in, we're looking now for a dip to take our first trade. So in this example, let's say this next day, we had a dip where the price, if you look at this lower part of this bar, this price was below the daily. And so we had a potential long at 6480 or thereabouts with a stop loss at 6415. The next day, the 3-day swing is still valid. So our second long trade would be taken at, let's say, 6480 once again, and our stop loss is at 6415. And the next day, we open up our system again and we find yet another bar and the prices are dipping below 6475. And so we can take yet another long trade at, let's say, 6475 and place our stop at 6415. Now let's enter these trades on a spreadsheet and I'll show you exactly how we do this. Our account balance being 10,000. Now, we're taking a long-term trade. So we might end up taking 5 or 6 trades. So rather than 2% risk, we will reduce our risk to maybe 1/5 of that, 0.2%, or 0.5. Let's say 0.5. And what that would do is each day's trade would add risk to the portfolio, so 0.5% on each day. And if we end up taking 4 trades or 5 trades, our total portfolio risk would be carried at, let's say, 2.5%. So we'll start out our first trade with a 0.5% risk, which means it's $50. And our price stop is at, let's say, in this case, it's 0.6415, right? And our entry is at 0.6480, right? So on a 1:1, that's a risk of 65 pips. Now that's in this current scenario, let's take the safe case and do a risk reward ratio of just 1. Okay. So the size of the trade that this qualifies is 50 pips or $50 divided by the risk. So it qualifies us for a trade which is about $7,000. So let's take $7,000 as our first trade. And what that would do is we would automatically calculate. So let's say it's 6545 is the target. So at 6545, if we took the trade at 6480, that trade would automatically have a take profit of 6545. So let's assume our first trade is 7,000. We enter it at 6480. The stop loss is 6415. And let's skip this for the moment. I'll come to that later. And our take profit would be set at 0.6545. Now, similarly, if we do this next trade, if the next trade was there, our stop would be the same at 6415. Our entry was again the same, 6480. So it's an identical trade. Our third trade in this example is taken at 6475. So let's get to that. Entry is at 0.6475, where the stop loss at 6415, right? And what that does is the risk is 60 pips in that case. So the trade size that it qualifies is 8,000. So our next trade will be $8,000. Now, I hope you're understanding that these targets are automatically set. It's built into my spreadsheet. So if you had a risk of 1x, which is 60 pips, then this target is automatically adding 60 pips to our entry price, which is 6475, and computing the profit target right there. Now, if you had set a 2-to-1, then your profit target would be 120 pips, in which case your target would be automatically computed at 6595. Now, one of the reasons why I'm not taking a 2-to-1 ratio right here is that this weekly trend is moving against the 27-day trend. So it's a counter trend, and therefore it's unlikely that we will reach a 2x price target because it's against the longer term trend. So this is a medium term trend, which is a correction, and therefore 1:1 would be a far better reward to risk ratio. Okay, so we've got these three trades here, and let me save that for a second. So let's move on and let's take the next 3 days. Now, here's an important bit now. We've seen 6 up days, and we know this is a counter trend. And this is where taking profits can be very tricky. And each trader's profit can be different depending on their personality. So if I was a very safe trader and I said, well, let me just trail my stops, then I might say, look, we're trailing above 60, trailing at about 65.50. Let me move my stops to 65 cents, right? Now, if I had those, my trailing stop would mean that this trade, the first trade, which I took at 64.80, now has a stop loss of 65, which means if I move my stop to 65, I would still end up making $14 on this trade, right? Similarly, the other trades also would be at profit. So the first 4 trades would be at profit, but the last 2 trades would not because my entry was higher than 65. So my pending risk on this, on the entire portfolio, is only $1. So it's almost zero. So I'm almost in a risk-free position. And this would be fine if we were trading a very long-term trend, but we know that we are right now short on a 27-day basis. So we should be booking our profits and exiting. Okay. So let's see where the prices have reached. The first one was at 6545. So we've certainly made 46. We made that money because of the price move. You can see right there, the price did go up above 65.50, right? So $46 is done and it's made. The next trade also has made. The third has also made money. The fourth has not. The fourth has also made money. This one has not made money. And so this is still pending. So these two trades are still pending. And so what we've done is this money has already been made. And so we can just add up how much money has already been made. That's $191 that's already been made. And these last two trades are still sitting in the portfolio with a loss of $55. So we still made $140. And $140 is 1.4% on the portfolio. So we're through. We're through with our target. Now, let's take another scenario. Let's assume that another trader said, no, I don't want to take profits. I'll just trail the stops and see where it goes. Now, if they trailed their stop and just went with it, then they could close their position at market. Now, market value, let's say today is at 65.54. It's right there, right? And you might decide, well, no, I don't want to trail my stops. I made enough money. I'll book my profit exactly where it is. So here you have the market price, 65.54. By the way, you can get your spreadsheets to automatically feed this in. So if you go to Google Finance and create a Google Finance spreadsheet and put in that formula in this cell, you would get a real-time feed of that price. If, for instance, they said, no, I want to do my take profits and I want to trail my stop. So he would have just two trades outstanding, which means that there'll be $53 additional he could book. So instead of 285, third trader would be having 191 that he's already booked as profits, plus he would book another $53. So say $240. So he's made money as well with his strategy, assuming he entered a take profit on every trade. Okay, so that's broadly how you would enter your spreadsheet. Now, let's go through the trading stats. Let's say the week is over. You're sitting in on a Saturday and reviewing it. Okay. Now, let's enter these trades, assuming the first trader position where they actually booked their profit. So my first trade was, let's say, at 7,000. Entry was at 6,480, and my profit was 46 for that, right? That's the first entry. My second trade was at 7,000. Entry was at 6,480. I entered it on 28th of August. And my profit was $46 on that, right? Third trade was for 8,000. And I entered at 6,475. And I made $50 on that one by booking a profit. My fourth trade was for 11,000, was at 6,495, and I booked a $49 profit on that. And here's where the question mark is. So let's assume that we had a trader who booked his take profits and he says, I'm not going to book profits at market. I'm just going to trail my stops and I'm going to have take profit targets. So let's say the third trade, 7,000, which was entered at 6,517, let's say the market drops on Monday. And so this trader would end up losing $12 because that trade would hit the stop loss and he'll have a $12 loss on that. Okay, and the last trade was 13, entered at 6,533. And again, that one also hit a loss. So that went into a minus 43. Now, you can, on each of these trades, enter your lessons. So for instance, this might have been, didn't wait for a dip. Okay, so you just enter that. And this one, it says, well, hasty. So let's say this trader, he took this trade when he was rushing out, there was a movie coming up or he had to go out, and he didn't look at the market enough and took a premature trade. So this is what builds your history of lessons. Your personality as a trader starts to come through here. Okay. Now, if you start to total up these stats, you'll find you can compute this. So this is you had 4 wins and 2 losses. So you had a hit rate of 2-1, which is good, which is excellent. 2-1 hit rate is excellent. That means you have twice as many wins as you have losses. And your average win was $47. Your average loss was $28. So that's excellent. A win-loss ratio of 1.74. That is brilliant, actually. Your total wins were 191 in this case, and your total losses were 55. So that's the total right there. And so your total net profit was 1.36% on the portfolio. Okay. Now, if you take another scenario and you looked at a trader who said, well, no, I'm going to just book it at market value. Then you have the first trade would have given you $52. The next one would have also given you 52. The third one would have given you 63. And then you would have had 65, 26, and 27. Now that is a phenomenal return, right? Because you have all 6. You have a 100% hit rate. Your average is $47.50. So there is no question of a win-loss ratio. You have no losses. And that's a phenomenal 2.85% return on the account. So you can see that while risk management is one side of the equation, booking profits is the other side. And it can have a significant impact on your trading stats. And there is no fixed answer for this. You can choose to trade a fixed profit system and you continue to trail your profits, your losses. This is what makes the personality of the traders so different. This is what determines their success at the end of the day. You can have a perfect system, but there are no rules about where to book your profit. You could scalp. So some of these could be just 6 or 7 trades in a single day. Scalping, that's another strategy. So that's all variable. But I hope you understand how the risk management spreadsheet is done, how having a well worked out spreadsheet works, because you don't have to do the maths in your head. It's right there. You just plug in the numbers and it's there. And probably as an exercise, you might try and creating this kind of a spreadsheet on your own. It's very simple. All you have to do is plug some formulas in. But this is given to you just as a sample, so you can try it on your own, create your own spreadsheet, and track your own performance. Okay, so that's basically all I wanted to cover for today. And I hope that gives you a good, robust understanding. Please don't underestimate the importance of this step. If you don't do your risk management properly and you start to do the numbers in your head, just off the cuff, back of the envelope kind of stuff, your trading performance will be impacted, guaranteed, 100%. Now, one of the things with what we've done is this bottom bit. Okay, risk management. We are aware now that how to size the positions, how to set your targets, monitor. We've done this piece. But the piece that's missing still is building a trading system. Let me take an analogy. You're cycling. You say, hey, I'm going to cycle, right? So you put a cycling helmet on and you got ordinary cycle brakes. You don't fit pneumatic brakes on your cycle. You don't need them. Yeah, you do need a helmet. You might need knee guards depending on where you're going. If you're going mountain biking, that's different. Now, if you're going swimming, you don't need a helmet, right? And if you're going scuba diving, you need oxygen tanks. So the point is, depending on which journey you're taking, your risk management is built around that. All that we've learned so far is how to set your position size based on your stops. But there is a huge gap on the top end, building a trading system. And the way the process works is here's where you're all at. See, we've got this. We've developed an understanding of the Forex market. We've checked out some brokers. We know what MT4 is. We've come to opening, closing, setting stops, and moving averages. But is that a complete strategy? We don't know. We have position sizing. We've done this piece, this little piece. Just watch. This one is missing. And what happens is the combination of your system and managing risk will help you get your trading stats, and it'll tell you whether the system that you're following is valid or not. Is it a good system or not? Did you guys go see F1? There's a scene there which is really telling. So I forget what the technical director's name is, Kate McKenna, someone. So she built this car for speed, right? She has this wind tunnel in which she was measuring it, and the car was zooming along, 250, 300 kilometers, miles an hour, whatever, because the air was clean. It was coming straight through, and she was just looking at perfect aerodynamics for the car. Now, when Brad Pitt actually drove the car, he was following so many other cars, and the air wasn't clean. It was all over the place. There was rain, there was dust, there were cars overtaking him. The aerodynamics was crappy. It was nowhere near the air tunnel. And so he was the one experiencing it. Kate had no idea. She was building it in a classroom. And so when Sonny came back, they had this battle. And Brad Pitt said, hey, I don't want a car built for speed. I want a car built for combat. I want the aerodynamics reset in a way that the car hugs the ground. It doesn't deviate from its path. So rebuild me spoilers that will support the car, that stays on the ground. And that's actually what you're doing here. You're designing a system or a strategy in a laboratory, exactly the way Kate did, with moving averages. And you say, well, it looks right, Sunil did it on a screen and it looked good, and I think it'd be great. But when the market is there and you're starting to trade that system in the market in real time, you will realize that that's sadly lacking. There are a number of things over here that I've not mentioned yet. And that's your own analysis. As you go and say, hang on, and it'll come back with, God, I wish I knew ABC. And that's what will build your trading system. So you'll figure out that's what's missing, and the answer to what's missing will end up going back on top, and you will say, let me add an RSI here, or let me add an Ichimoku indicator, or let me add a cloud. Those are the things that you'll end up adding, and only you can do it because it's your personality. See, Sonny's competitor, what is his name? Joshua. He never figured it out. And so each of your personalities will actually tailor whatever system you take in the laboratory, and you will tailor it and manage it and modify it so that it suits you. I have a friend, he does not keep the Forex trading system on his mobile. He refuses to. He insists on coming back home and looking at it on his computer. Whereas, I keep MetaTrader 4 on my mobile. So whether I'm in a movie or I'm out with friends, it takes me barely a second. I open up my mobile, I take the trade, or I close my profit, and so I'm right on top of the market. He has an inability to trade during the day. There are specific times that he can trade. And so he has to go with a different system. He cannot scalp. It's impossible for him to scalp. So this is an iterative process. And we're about to go into it now as we go and discover new trading systems. All right, so that's all I had for today. And I'm happy to take questions and answers at this point. And let's see where we go.
Yeah, the first is the whole T-stop concept. If you can help us understand
this
the
price
T-stop.
This one?
No, the T underscore stop.
Oh, I see. So the trailing stop is a discretionary amount. If you, for instance, if you're trading a really long-term trend, and let's say in a day or 2 days, You say, well, it's in the money. I'm going to trail my stop so that if the price suddenly dives, I don't end up making a loss. I'll end up at least booking some profit. So what you do is you trail your stop. That's just short for trail stop. And so what you do is you gradually raise it so that it's at a comfortable level. The first point where you raise it is usually your cost price. So, if the price suddenly dives, the market tanks, at least you won't lose any money. And then once the price starts to really move in your favor, then you can actually lock in some profits.
So it's
Can the trailing
basically
stop also be in percentages?
Yes, it can. If you choose to
Okay,
calculate it that way, you can set it as a percentage. So you might say, well, my stop was at 2%. Now I'm going to set it at 1%.
right. Okay.
Okay, so that's it from me for now. For those of you who are listening to us on YouTube, please note this is going to be the last episode that will be recorded and aired. After this, all the content in my sessions is proprietary and I run special classes for those. So if you're interested, please head over to forexwithsk.com and you'll have more details there on how to subscribe. You can shoot me questions, emails, whatever, and I'm happy to answer them for you. All right, thanks for joining us today. Goodbye, good luck, and happy trading.